Today, we are diving deep into a question that keeps every investor up at night. Can you actually beat the market? And we're going to use the blueprint from an absolute legend, Benjamin Graham, to figure it out.
So, let's be honest. Is it really possible? Can you, as an individual, consistently pick stocks that do better than the overall market average? It's the ultimate goal, right? But for almost everyone, it feels more like a fantasy than a real possibility.
Well, Benjamin Graham, the guy who mentored Warren Buffett, he said, yes, you can. He literally wrote the book on it. But, and this is a huge but, he started with a pretty serious warning. Most people who try to beat the market are gonna fail, even the really smart ones. So what gives? Why is it so incredibly difficult?
That leads us right into the market's big paradox. See, before you can figure out how to win the game, you first have to understand why so many brilliant, well-informed people end up losing it. Graham said it boils down to two major problems. First, the market is just ridiculously efficient. Good news gets baked into a stock's price in the blink of an eye. And second, Wall Street has a serious bias problem. Analysts all tend to chase the same handful of hot, popular growth stocks, creating this massive herd behavior that pushes prices way beyond any rational level.
Graham had the perfect case study for this, the airline industry. Think about it. Back in the day, it was a total no-brainer that air travel was going to be huge. It was the future. Investing in it seemed like the surest bet you could make. So, what do you think happened?
An absolute train wreck. Despite the fact that air traffic grew like crazy, the industry was a black hole for investor money. In just 1 year, 1970, shareholders lost $200 million. And here's the lesson. Being right about an industry's future means absolutely nothing if you pay too much to be a part of it.
All right, so if chasing the obvious, exciting growth story is a trap, what on earth are you supposed to do? This is where we get into Graham's actual blueprint, a systematic, almost scientific way to find real undervalued companies.
He didn't just wing it. He broke his analysis down into 5 key areas. He insisted that before you even think about buying a stock, you had to systematically check its size, how strong its finances were, the stability of its profits, its track record of paying dividends, and, the most important of all, its valuation. And what's so powerful about Graham's method is that it's not based on feelings or vague ideas. He gave you cold, hard numbers. He wanted a price-to-earnings ratio under 10. He wanted to see that the company's debt was less than its ready cash. This wasn't a guessing game. It was a rigorous checklist designed to take your emotions completely out of the equation. Now, it's really important to know who this is for. Graham laid out 2 paths. There's the defensive investor, who basically just wants to play it safe and not make any huge blunders. But this whole system we're talking about, that's for the enterprising investor, the person who is willing to roll up their sleeves and put in the real work to hunt down the best deals.
Okay, let's be real. That 7-point checklist, it's a ton of work. And Graham knew that, so he also gave us a couple of simpler, more focused strategies that still get to the very heart of his value philosophy.
The first one is what you could call the low-multiplier strategy, and the second is the deep bargain bin approach. Both are designed to find undervalued gems. They just go about it a little differently. Let's break them down.
The first strategy is beautifully simple. You take a list of high-quality companies, like the ones in the Dow Jones, and you just buy the ones that are statistically the cheapest, the ones with the lowest PE ratios. And just look at the results here. A $10,000 investment in these unpopular stocks grew to almost 67 grand. It blew away the popular high flyers and the average. It works because the market loves to overreact and punish perfectly good companies that are just having a temporary bad year.
Now, this second strategy is even more wild. This is where you go digging in the absolute bargain bin. You're looking for companies that are trading for less than the cash they have on hand after you pay off all their debts. Think about that. You are literally getting the entire business, the factories, the brand, the employees, all of it, for free. It's the ultimate safety net.
So, we have these clear, logical systems. We have historical data showing they work. So, what's the catch? Well, the biggest obstacle isn't in a spreadsheet. It's staring back at you in the mirror. Come on. If it can happen to Sir Isaac Newton, it can happen to anyone. The man was one of the greatest geniuses who ever lived. He got swept up in a huge market bubble, cashed out with a profit, but then got FOMO and jumped back in right at the very top, and lost everything. His incredible brain was zero defense against the psychology of the crowd. And that brings us to what is maybe Graham's most important insight of all. He believed that successful investing has very little to do with your IQ. It's not about being the smartest person in the room. It is almost entirely a game of character, of temperament, of discipline. Because the real challenge is just avoiding these traps. Chasing hype, ignoring what a company is actually worth, blindly following the so-called experts, getting cocky after a few wins, these are the things that sink investors. You can have the best system in the world, but it's worthless if you don't have the discipline to stick with it.
All of this funnels down into the single most important idea in Graham's entire universe, the margin of safety. It is everything. It's your shield against bad luck, a crazy market, and most of all, your own human error. The rule is dead simple. Only buy something for significantly less than you think it's worth. That gap, that discount, that's your protection.
So, let's nail down the key takeaways. Number 1, a good system will always beat your gut feelings. 2, you can find incredible opportunities in good companies that the market has temporarily tossed aside. 3, and this is the big one, who you are is more important than how smart you are. And finally, you must always demand a margin of safety.
Look, Benjamin Graham gave us the map. History has shown us that these principles work. The logic is sound, the tools are right there for you to use. After all this, there's really only one variable left in the equation, and that's you. Does the method work? Yes. The real question is, do you?